Good afternoon. So we are ready to start our next webinar. Let's wait one more minute. Maybe somebody will join as well. And while we are waiting, could you please write in chat, do you hear me well, if everything is good? Okay, let's go. So there are several types of companies. They're a growing company, and you're lucky if you have so. There is stable companies, a company that exists many years and pays dividends. And there are companies with huge level of uncertainty, with huge stress when you kind of on the one hand, the revenue is growing. On the other hand, you don't have any free cash because each month you are stressed because you don't know can you pay to your suppliers or salaries or not. So the main problem is that the difference between growing company and distressed asset like company with uncertainty is not so big, because when you're growing, you can face the situations that your revenue is growing, but your EBIT is not, because you're reinvesting money to marketing, to another activities. But in the stress asset, you also can face the situation. The only difference is that in growing company, you control your finance. You understand that, yes, now it is my decision that I focus on revenue and I invest my gross revenue in further growth. So, and that's why I don't have any positive cash flow. But in distressed asset, you don't understand. You're going by your feelings, and you can win. You can build a business even without understanding of all the finance. But also you can face a situation that you can face bankruptcy, because when you're going by feeling, you're not safe enough. So, regarding the distressed asset, I want to share one case that we, as a fractional CFO, have faced 1 year ago. So 1 year ago, the company named Familiar Hair, so basically large enough brand from US and Israel, they came to us and they said, we need help in order to make clarity in our finances. And we, as a fractional CFO, we have offered to them several packages with different pricing, and they answered, the problem is that we have no idea how much we can pay to you. And this is very good when business understands it, so that money on their bank account is not equal to money that they can pay, because you always have some liabilities. You always need to think not only in this day, but you need to think kind of in a longer period. So, and we started to work the client. We started to find some possibilities to understand its situation. And the main client targets was to grow, to increase revenue. But revenue is not always means that you will have more money, because when you are increasing revenue, your operational costs are growing. You have more unexpected costs. Your marketing costs are growing. You need to freeze more money because you need to buy extra stock. And if you control those processes, it is okay. You can scale, you can increase revenue in the right way, you can increase revenue in this way that your EBITDA will grow as well. But if you don't control, there is huge probability that your operational cost, marketing cost, and so on will grow faster than your revenue. And you will face very unpleasant situation when you have more work, more hassle, more problems, and less money in the end of the day. Despite that on your bank account, maybe you can see a lot of money, but it is not your money. It is money of your suppliers, it is money of your employees, and it is money of some unexpected stuff that you can face. So that's why the right strategy to grow is described in 3 words, in 3 steps. The first step is stabilize. We need to understand at which moment we are, at which point we are, what is our point A. So we need to understand our current situation, all our cost, all our liabilities, all our revenue sources. So we need to understand all the metrics. We need to understand the gross margin for each product, for each sales channel, and what we were done for this client. So firstly, we just understood the current situation. Then, when we know everything about our point A, we need to find some stuff that we can make more effective. We need to exclude loan with huge interest. We need to avoid products with negative margin. We need to go out from sales channels that have bad ROI, and so on. And when we have optimized business with as effective as it could be at that point, only at this point we can scale it. By scaling, it means that we can invest money in those activities, in those products, in those channels that can help us to grow. And usually between point A until kind of scaling, it can take up to 6 months. So as it was in the case with our clients, so when we started to work with him, and then only in 6 months we started to scale this business. And when you are ready to scale, you need to have several tools that should be done for scaling. First of all, you need to have transparent finance that you can track on a daily basis, because when you're scaling, you are going to a high risk field, and each your step, it may as kind of a good direction, so you can increase your revenue, increase your EBITDA. Also, you can move you in a bad way, so you can face cash gaps, you can face some unexpected losses, etc. So that's why you need to control your finance on a daily basis. You need to see in the best way, you need to see all the metrics, but at least you need to see the main metrics that are crucial for a business, that are crucial for scaling. All the metrics in dashboard, in finance model, doesn't help you if you will not transform it into the actions, and those actions you need to transform into the KPI. So each cell in the Excel, each block in dashboard should have a relevant person who is responsible for this number. For example, if you're in your finance model have a growth rate, 5% per month, you need to find a specific person, or it should be you, who will be responsible to reach those 5% per month. And only in this way, the scaling will work, because if it is only numbers, if it is only some projections, so you can draw anything, you can simulate anything, but it will not work until there would be responsible people who will help to implement those numbers to go to the scaling. And the third one is stress test or sensitivity analysis. Unfortunately, we don't know the future. So that's why when we are making our forecast, when we are projecting our scaling potential, we need to stress test several scenarios. We need to understand, okay, what is maximum cost of acquisition for clients that we can afford for ourselves? What is minimum margins that we can afford for ourselves? And then when we have all these frames, we can go further and we can scale, and we can see, okay, I can accept this project, I can accept this marketing channel, because I already run thousands of scenarios, and I can see the critical numbers that I can afford to scale my business. Besides all this basic stuff like finance model, sensitivity analysis, and kind of KPIs, you need to have some tools that also we have implemented to our clients that help him to grow. It is, first of all, 12 months or 6 months or 13 weeks, so there could be different stuff. Kind of cash flow runway tracker. So when you can track all your cash flow, specifically when you see that you don't have any cash gaps, when you can forecast all your further expenses, etc. So, and you need to have it, because without it you can face the problems that you need to pay to your suppliers and you don't have money. So first of all, it is kind of the main tools that you need to have. Second one is longer term, like 5 years or 10 years or 3 years scenario model, when you have long-term vision, when you understand, okay, I'm moving in this direction. And in the best way, both those kind of tools should be in the same direction. So it could be aligned one with other. So also, if we are speaking about e-com business, so you need to have inventory cycle optimization. You need to avoid the situation when you freeze a lot of money, because if you're freezing a lot of money, you kind of refuse from the growth. You are replacing your growth with just freezing money, because you can invest those money in marketing, you can invest those money in new inventory or in new sales channels, but you just froze it in stocks that is not relevant. And also you can avoid the situation when you don't have stock and you lose your revenue because you already invested in clients, you invested in marketing, clients came to you and you don't have anything to sell them. So that's why you need to optimize your inventory, you need to control it as well. And you need to have unit economics, and you, in a good way, it should be as deep as possible because when you are scaling, unit economic is like a king for your business. We have considered everything for these clients, like starting from LTV and finishing with gross margin per each product. So in this case, we can avoid all the channels, all the elements of the business that are negatively impacted on our scale. But in order to do it, we need to go as deep as possible. And always we have some debts, we have some other investors, etc. So that's why we have to consider capital structure model as well. We need to understand, okay, we need so much money to go to the next level, and where we will find this money. So if it would be debt, so what is the interest rate? If it would be equity, how big share I will lose? If we are speaking about those four elements, it is very beneficial for business and healthy for business. This element firstly beneficial for you as a founder, because sometimes, yes, your business can grow, but you have lost so big share of your business that in the end of the day, it is not beneficial for you. And all those tools should be transformed to decision matrix, because all the numbers, as I already said, will not affect your business. All the projections will not affect your business. It will affect your business only if you transformed it into the decision matrix, and from each number you can see the next steps. For example, if you can see that your cost of acquisition is, I don't know, $10, this information doesn't make any sense. But when you see, okay, it's $10, market benchmark is $5, so it means that, and by our forecast, we can afford for ourselves only $7 cost of acquisition. It means that we very urgently need to change our marketing strategy. It means that we need to close those channels who provide clients to us with $10 cost of acquisition. So when we have those decisions, those kind of call to action from each metrics, it will make our way to scaling very fast and very effective. As a result, for these clients, when we have worked with him during the 12 months, and during the first 6 months, we just optimized all his business and prepared him to scaling. After that, he has received $700,000 as external funding, so as investment. He has avoided $150,000 as interest rate payment because we restructured his debt. He has grown by 150% only at Amazon and 200% in Shopify. And also he went to the new markets in MENA region and in China. So I believe you want to have the same success. So that's why I will show you some products, some tools, what you need to do to prepare to scaling. The first one is very boring. It is finance model, but it is crucial. So you need to do it. So usually founders, they are just looking on first page to see summary, to see some graphs, some charts, and understand, okay, looks good. So each month I have column that is bigger than the previous month or previous year. So basically it is the right direction. But besides those charts, we have several tabs. We have, first of all, the list of assumptions. So when we are starting to project our future, when we are start to understand is scaling beneficial or not, we have thousands of scenarios, because from each assumption we have different scenario and different result. So that's why we need to find some assumptions that on the one hand is very realistic, so we know that we can achieve it. On the other hand, it is growing and it can help us to grow. So, and we are putting everything, starting from margin, finishing with all the salaries, with all the debts and so on. All those assumptions are transformed into forecasts, so we can see how it changed our business during the months, during the year. And only then we are putting different stress test scenario, and we can see, okay, is it okay for us, for investor, for the future? Do we want to achieve those numbers? Is it enough challenging or not? Is it possible? When we have kind of all the finance model, we need something to understand, can we achieve it or not? And we need to track it on a daily basis. So that's why we need to have a dashboard. We need to have something what we can see on a daily basis, when we can see all the main numbers and we need to control it. All those numbers, again, they need to have call to action. So that's why we need to see, do we have any risk? Is it okay? So are we growing good enough? Is it aligned with our plan? So of course, the revenue and gross profit are the main metrics, because it are the main indicators and the main drivers for the scaling. So OPEX is crucial as well, because if our OPEX is too high and higher than gross profit, so we need to find out the way how we can cover this cash debt, because in another way we can grow, but at one point in terms of revenue. But if our OPEX is huge enough, then at one point our growth will be stopped because of bankruptcy. So we have to see all the risks. We have to see, when you're growing, we don't need to be dependent on one sales channels. We don't need to be dependent on one product, because it is also huge risk for the business. We have to control all the P&L statement, because it is good when you have enough cash, but cash is not equal your profit, because you can have cash from future revenue. For example, if somebody paid you in advance, you can have cash because of debts. It's something that is not scalable. So, but when we are looking at P&L, at EBITDA, it is something that we can scale, we can multiply, and in the end of the day, we can reach those level that we wanted, that we planned. When we are considering our P&L, we have to see all the contribution margin by each channel, by each product. We need to compare months over months plans, and always we need to compare actual with our plan. And if we have any kind of discrepancy here, we need to understand what is the reason beside it. So what we need to do, it is okay when our actual is bigger than plan. So then we are going faster than we expected. But if this is lower than our plan, we have to find all the reasons why we didn't achieve our plan. And then we need to decide, okay, we need to adjust our plan and we will not reach those targets that we planned before. Or we need to adjust our plans that we will grow faster in order to reach our target at the end of this year, for example. Also, for e-com business, it is crucial to consider the products and to understand each product in our line. So because very often we can face a situation, even in big businesses, that they have several products in line with negative margin, and it make your scaling harder, because part of your revenue, of your EBITDA, goes to cover those losses that you can avoid with one easy step. You need to just stop selling those products. So that's why we have to consider all your stock. You need to consider your inventory in terms that you don't freeze money and you have enough stock, and you need to consider kind of your gross margin, not only by product, but by channel as well. So, for example, because sometimes it can happen that in Amazon you have positive margin, but in Shopify negative. So that's why it is also crucial to look on your product line from this different perspective. Marketing is main your kind of investment channel, because usually e-com business, they don't invest in, I don't know, real estate or something like that, but all their investment goes to the marketing. So that's why each channel should be considered. You need to know cost acquisition by each channel. You need to know payback by each channel. You need to kind of see the best channels and the worst one, and all, like on a monthly basis, on a daily basis, and to replace the worst performing with good performing to kind of increase your efficiency month over month. And of course, when we are going about speaking about scaling, we are speaking about the future, because scaling, it is process oriented on the future. So that's why we always need to know our like runway, especially if we have negative EBITDA in this moment. We need to understand the direction which we are going. We need to be sure that we will have enough money in the future. We will not face any cash gaps, because in this case our scaling is senseless, because if we can face cash gap, it means that we can face bankruptcy as well. And yes, so basically there are kind of a lot of information, so what you need to have in order to scale, but there should be like a small checklist to understand, is your business ready to scale or not. First of all, you need to have positive gross margin, because if your gross margin is negative, so it doesn't make any sense to scale it. So it is the first reason that you need to first kind of benchmark, first metrics that you need to change. All the smart books tells that our gross margin should be more than 30%, but there are thousands of different businesses, and there are businesses with gross margin 0.5%. It is okay, so because of the business. But also you need to understand as lower gross margin you have, so you have less opportunity for mistake. So because when you have really low gross margin, you don't have any chance to mistake, because you don't have enough money to cover this mistake. With high margin, you can make some mistakes and you can survive after that. So also the crucial metric is LTV over cost acquisition, and it should be higher than 3, because if it will be lower than 3, you will never grow, because all your money you will again spend into the acquisition of new clients, and you will be on the same level. So that's why you need to understand if in this level of your business you have this metric, and your marketing work efficiency and your lifetime value of clients is large enough. So it means that average check of client is big enough and client make repeated sales. So then it is, this business is ready to scale. If clients like costs a lot and after one sale he disappeared, so then we first of all need to change the situation, we need to improve it, and only then we can go to the scaling. And the last but not least, we need to have transparent finances. We need to understand our EBITDA. We need to be sure that this EBITDA is real. We can believe to those numbers, and we can like honestly answer to ourselves about all our metrics, about our balance, about our cash flow, about our P&L, and so on. Yes, so basically it was kind of the end of presentation, and I would be happy to answer on all your questions in the chat. So I can see the question from Nikita. He asked, can I help them to scale logistic company? So for sure, logistic company is one of the companies with low margin. So basically that's why we don't have any chance to mistake, because we can face the situations that each month we are earning by like small margin, and then if we will have some, I don't know, bad order in the end of the year, we can lose all our profits. So that's why first of all we need to control everything. We need to be sure that we have hedged all our risks. And in order to scale, so basically it is B2B business, so we need to increase our number of like sales team. And also, if I'm not mistaken, in logistic you pay upfront, so you always need to freeze your cash. So that's why we need to be very accurate with our cash conversion cycle. We need to find maybe some factoring with low enough interest rate, because you always need extra cash, because you always need to freeze it. It would be like perfect situation if in such businesses you can find some, I don't know, one more, not channel, but direction where you can sell your services, but you can receive money up front. So in this case, you will not freeze so much money, and you can kind of grow more effectively. But usually it is hard to do it. But even if you will find something with money up front with zero margin, so it also can help you to grow and to go to the next level. So Natalia asks, do you see Shopify good for e-commerce sales? So as I know, currently Shopify is one of the best tools. So there are like several tools in the market, like let's say Amazon, Shopify, WooCommerce, it is part of WordPress, etc. And Amazon, as I see, currently has less and less clients because they have a lot of commission. It is hard to onboard new products or new business here, but it exists, so they have their own clients. Shopify is more flexible, and they have lower commissions. You can easier make marketing on this Shopify. So I believe that Shopify is good enough. So, and I think that largest part of new businesses, they started on Shopify or in WooCommerce. So, and they can scale. So Anastasia asks, what is the normal margin for fashion goods sales? Okay, very good question. So usually fashion goods sales, so the margin fluctuates from 30% to 50, I would say. So it can be, let's say, 20% or even 15% if it is the dropshipping model, when you don't freeze money, when you don't have your own stock. So you just found the factory, and from the factory you sell directly to the customer. But you cannot scale this model, because at some point it wouldn't be like 15% will not cover your OPEX, etc. So, and there is huge risk that you will depend always on one factory. But when we are speaking about like business, when you have your own inventory, it like starts from 30%. So it should be your minimum. But sometimes if you have some unique products, I don't know, with like huge brand, it could be even more than 50%. So Artur asks, how do you structure P&L for an early stage Shopify store? So it depends. So again, because no, basically the P&L is structured. There is one way how we can structure P&L. So we have our revenue, so it is our number of sales. Then we have our COGS, and it is crucial that COGS need to include not only the self cost of the product. It should include also the commission of the Shopify, commission of the Stripe, or any other payment solution. It's all the taxes, duties that you have. Then you have gross revenue. After the gross revenue, you have all the marketing costs, or like sales costs, and after that you have EBITDA. So it is like the structure of the P&L. The tricky question is not about P&L, but about the cash flow, because in the cash flow, it depends when you are paying. Are you paying in advance? Do you have your own inventory, or you are paying upfront if it is dropshipping model? And you need to be very accurate with that, because there are situations when by P&L you are a very positive company and you have huge EBITDA, but in reality you always have cash gaps because you need to pay in advance. Yes, thank you, Natalia, for booking the call. Talk with you tomorrow. So anyone else, also please book the call. I will be happy to consider your business, and I hope that I will be able to help you to grow. So if you don't have any more questions, I want to say thank you for listening to me. I hope that it was useful, and see you on the next webinars. Thank you very much.